The Fed is set to conclude its two-day policy meeting, and our next guest says that the central bank's premature dovishness is coming home to roost in the form of increased risk of stagflation. Joining us now is Komal Sri-Kumar, president of Sri-Kumar Global Strategies. Sri, it's good to have you on, and there's a lot of cross currents. Good to see it. A lot of cross currents in this, and things I have questions about. I guess your base case is that it's the strength that we're seeing, continued strength in the economy, makes rate cuts unlikely, in your view, maybe even for the year, and that the risk is, since we don't get rate cuts, we could eventually have a hard landing.
That's correct. All of the above that you said, Joe, and I think I saw no reason for the dovishness that we saw from the chairman in his December 13th press conference. He again repeated it before the Senate Banking Committee earlier this month, talking about interest rates being quite close by. And then clearly the markets reacted to it. There is a rally, and the rally makes it more difficult to control inflation at a future point in time. It would have been better to be more cautious on the forecast in terms of expectations, so that you don't have to reverse, and that is the risk I think the Fed is running. They give rise to expectations of rate cuts, eventually to have to say this caused a rally, this eased financial conditions, now we may have to tighten again.
Seems insane. It does seem crazy if you've had 18 straight records in the averages, the stock market averages, that you're thinking about cutting, but we do have an election coming. I know they're not political, but they can't help but feel the political winds a little bit.
They are political. I have always maintained that the Fed is a political entity. They're talking about being independent is just a smokescreen. In reality, they have been very vulnerable to political changes. Even if you go back to history, toward the end of 1971, Arthur Burns, the Fed chairman, writes into the FOMC minutes that they have to be increasing interest rates in 1971 because we will not be able to do that next year, 1972, which will be an election year. So there have been explicit references to politics, and to pretend that this is an apolitical entity just doesn't make sense. And look again at one of the other things they have to think about this week, Joe. They have to think in terms of slowing quantitative tightening. In other words, the rate at which they put bonds back into the market. But where were we? 2008, at the collapse of Lehman Brothers, Fed balance sheet was about 5% of GDP. But the beginning of COVID in 2020, it rose to 19%. By 2022, 2 years later, it had increased to 35% of GDP. So when are we going to go back to a more normal level? So that is not mentioned either. So we are left with increasingly dominant Federal Reserve in the market performance.
I'll tell you the one thing that I didn't quite understand, Sri. You think the 10-year might be a buy. You think rates are kind of peaking there, and it might be buy for the next couple of years, because you think if it were to go up from here, something might break. So it's not going to go up. But, I mean, the 10-year doesn't, its behavior isn't dictated by whether it's going to break something. It goes where it's going to go, and then things break. You hope that they don't, but that's the way it happens. You think that just the possibility that something could break means that the rates don't go up to 5% or whatever, 4 3/4?
Right. This is the sequence. This is the logical sequence as I see it. If you have the Fed not cutting interest rates, not only today, but also May 31st or June 12th, then there is a pressure to push the 10-year yield up. We see the 2-year yield has already gone up significantly. What happens then is that the problems of mid-sized small banks which bought 10-year treasuries at 2%, they are going to be more underwater than they are today. The commercial real estate issues are going to get even worse. Those are the types of things that makes the Fed reverse and increase liquidity, cut interest rates, and that in turn brings the 10-year yield down. That's the sequence of my thinking.